Student question, what is the impact of the accounting equation if a sales invoice is not recorded? So to answer this question, we need to firstly remember what is the accounting equation. Well, it states that a firm's assets must equal its liabilities plus its owner's equity. So that's going to be true for every single business. It doesn't matter how big or small. We'll have a balance sheet and the total assets that we have will always add up to, in this case, $90,000. They will always add up to the total of the liabilities and therefore the owner's equity are added together, which in this case is $90,000. So whether we're a local store or BHP, we've got assets of $90,000 or $90 billion equaling liabilities of $30,000 and owner's equity of $60,000. What's important to remember is that the accounting equation is not just true for the business as a whole, it's also true for every single transaction. Let's take an example. Let's say you need $200 for a new pair of sneakers, but you only have $50 in your bank account. To make up the difference, you go to the bank and get a loan for $150 to be repaid by the end of the year. In the real world, this obviously happens every day, not for a $200 pair of shoes, but it happens for properties, it happens for vehicles, it happens for buying equipment and machinery, laptops, that sort of thing. And all that changes is the size of the numbers. But what we've got here is an asset of $200 in the form of a pair of sneakers, but we have a liability of $150, which is the loan to the bank. And therefore, the owner's equity, or the bit that you own of the shoes, is just $50. But again, assets equals liabilities plus owner's equity. What is the impact of sales though? So let's have a look. We need to remember that a business can make a sale for either cash, where it gets money, or credit, where the business gets a debtor, which is kind of like a legal IOU. The question we've been asked is, what is the impact if a sales invoice is not recorded? So an invoice is a credit sale. So we're going to answer this perspective from the business making a sale on credit to a debtor. Let's have an example. Let's say we're the business in the middle here. We buy stock from a supplier, iPhones, and we buy them from Apple for $200. We then go and sell them to customers for $500. That's a pretty standard transaction for a business. What is the impact of that sale on the accounting equation? So we've got an iPhone that we bought for $200 and we sold it for $500. So we've got an increase in assets of $500 because our debtors will go up. We've also got a $500 increase in owner's equity because sales, which is a revenue, has also gone up. What we need to remember though is that there's also going to be another part to this transaction. To make that $500 of sales, we have to give up $200 of stock. So our asset called stock would go down. That becomes what's called a cost of sale, which is an expense, and that will decrease owner's equity by $200 as well. And that's the full effect. So now we can add this up and say, what is the impact of this sale on the accounting equation? Well, assets went up $500 and down $200, so in total they're going to go up $300. Liabilities, there's absolutely zero effect. And owner's equity has gone up $500 and down $200, so it's gone up $300. And our accounting equation balances perfectly. We've got assets, $300 equals liabilities, 0, plus owner's equity, $300. One thing might complicate this though. What if that sale had GST? So, let's say it had GST. Everything else is the same. The phone costs $200 and the sale is $500, but that sale has $50 of GST on top of it. Let's just change some numbers. First of all, debtors is not going to go up $500, it's going to go up $550 because the debtor is going to owe the business for the phone and for the GST. That's how our tax system works in Australia. We've now still got a $500 sale. So what's different then is we're also going to increase our GST liability by $50. And you can see the asset of $550 equals liabilities of $50 and owner's equity of $500. So that still actually equals and balances from an accounting equation perspective. We've still got a cost of sale. Now the cost of sale doesn't have GST. It would have had GST when we bought it originally, but we're just selling it now. So stock goes down and cost of sales will decrease owner's equity. That's the entire impact. Let's look at the total effect on the accounting equation. Assets went up $550, but down $200. That's an increase of $350. Liabilities went up $50, and owner's equity went up $500, but down $200 for a total of $300. So again, our accounting equation balances assets up $350 equals liabilities up $50 plus owner's equity up 300. What's really tricky about this question is it says, what if this is not recorded? This is a very common exam question, so it makes it very, very difficult to answer. We've just figured out what happens when it is recorded, what happens when it's not. Well, to answer that, let's look at the sale without GST. What happened when we did have that sale? We had assets going up 300, liability 0, owner's equity 0, up 300. Well, what about if it wasn't recorded? Well, if it wasn't recorded, nothing happened. Impact on assets would be 0. Liabilities would be 0, and owner's equity would be 0. So, what is the impact on the accounting equation then? Well, the assets should be $300, but if you didn't record them, they're 0. That's too low. We can use the word understated as well. You're allowed to do that on the exam. You can use the words too low or understated. Now, if I did record that sale, assets would be 0, liabilities would be 0. If I didn't record it, they'd also be 0. So there is no effect one way or the other. Lastly, if I did record a sale, owner's equity should go up $300. If I didn't record it, it's going to be 0. So therefore, owner's equity would be $300 too low if I didn't record that sale. What about if the sale did have GST? So the impact there was assets went up 350, liabilities up 50, and owner's equity up 300. Now, if it wasn't recorded, we'd have 0 impact on assets, liabilities, and owner's equity. So what is the impact of not recording this item on the accounting equation? Well, assets should have gone up 350, but they actually were 0. So they are too low. The assets of $350 too low. The liabilities should have gone up 50, but instead they're 0. So last time without GST, there was no effect on liabilities, but this time there actually is. They're going to be $50 too low. Instead of being 0, they should be $50. Lastly, owner's equity should go up $300, but if it wasn't recorded, the impact is 0. So therefore, the overall impact on the accounting equation is it's going to be $300 too low. Let's look at this question and try and come up with a little answer we could write. What is the impact on the accounting equation if a sales invoice is not recorded? We're going to have two answers. What about if the sale doesn't have GST? Assets will be too low or understated. Liabilities, there will be no effect. And lastly, owner's equity would also be too low. What about if the sale is with GST? That was a little bit different. In that case, assets would be too low. Liabilities would also be too low. And so would owner's equity would be too low. It's a very complicated question. It's very difficult to understand. So please send through any questions you might have. But that is a very common exam question, and it's really hard to figure out the impact of something when it is not recorded. So try and look for lots of past examples and previous exams to try and get your skills up and try and formulate different answers for different types of transactions. We just did a sales invoice. What about if it was buying a new vehicle and that sort of thing? So make sure you practice a range of questions during your year.